In this video, we're exploring the topic of fraud, what it is, how it finds its way into financial statements, and what accountants and auditors can do to spot it. Plus, we'll look at the surprising reasons why some employees just don't report fraud, even when they know something shady is going on. There are a few different definitions for the term fraud, but this definition sums it up nicely. Fraud is the deliberate misrepresentation to gain an advantage over another party, typically to gain a financial advantage. Fraud comes in many different forms, including fraud in financial statements, the theft of assets and subsequent cover-up, and disclosure fraud. But just to clarify this, fraud is not the same as an error. When an error occurs, and honestly, who hasn't made one, there is this presumption that you did not intend to make it. Fraud is a purposeful act to mislead others. A common element of fraud is that it leads to material misrepresentation of the financial statements. How is fraud detected? According to the ACFE study of occupational fraud, the most common method of detection was a tip, with 43%. In organizations with hotlines, 49% came from a tip, but it declines to 31% in organizations with no hotline. So you really gotta ask yourself why organizations don't have one. Internal audit was next with 15%, followed by management review with 12%. The external audit only detected fraud in 4% of the cases. That means that the company should not look to the external auditors to detect fraud, but rather build and maintain strong internal controls and implement an effective audit committee. However, there's this belief that external auditors will find fraud in the financial statements, and that may happen, but typically only when it is a really huge deal, a material amount. To spot fraud before it happens, look out for red flags, and there will be signs. One Reddit post stated, "Everyone knew something was off. Nobody wanted to be the first to say it out loud. And we had a hotline, but using it felt like a career-ending move." Our textbook lists these and other red flags. Living beyond one's means with 39%, financial difficulties with 26%. But how do we spot these issues? Internal controls can help identify these behaviors, and some telltale signs might pop up in relationships with customers and vendors, like overly close associations, perhaps a little too cozy, or a sort of wheeler-dealer attitude. Plus, if an employee refuses to take their vacation days, that could mean they're trying to hide something. Companies often require employees to take at least 5 consecutive days off to make sure everything is above board. While internal controls won't guarantee fraud-free operations, they certainly help deter fraud and mitigate losses. And let's not forget hotlines. 49% of frauds are detected through tips in companies with a hotline. A tip doesn't come from software, though. It comes from a human being deciding to speak up despite risk. A strong internal audit team can help you stay ahead of the game if they're tuned into red flags and potential conflicts of interest. Okay, here's a little twist. Even though external audits catch fraud only 4% of the time, it's the most common anti-fraud tool companies use. Why? Because it's required by the SEC for public companies. External audits aren't really fraud detectors, though. They might deter fraud, but the real work of preventing fraud happens with strong internal controls. So what works best? Tone at the top, when leadership walks the walk and emphasizes ethical behavior. Add an internal audit department, conduct frequent reviews, and have management certify the financial statements. These are the anti-fraud controls that really get the job done. Reporting fraud isn't as easy as it sounds. Why not? Well, a whole bunch of factors make it tough. For one, it could be the poor tone at the top. If management doesn't value ethical behavior, why would employees? Another factor might be intimidating personalities. Employees may fear retribution or retaliation, or they might feel loyalty to colleagues. There's also the fear of the unknown. What happens if I report this? Will I lose my job? Or lack of trust. If employees feel like their concerns won't be taken seriously, why bother reporting? One comment that I noticed in an online forum was, they say open door policy, but everyone knows which doors not to open. Many companies are addressing these fears with anti-retaliation policies and procedures on how to handle whistleblower reports. So when choosing an employer, don't just look at the pay. Check out the company's culture and ethics too. Financial statement fraud can be tricky to detect, and there are three main ways it typically shows up. For instance, revenue overstatement. This could involve recording sales that haven't happened yet, booking sales for other companies, or even selling products that aren't really sold, like consignment items. Expense understatement occurs when people try to sneak costs into the wrong category or wrong year, or simply not report some expenses. Improper asset valuations includes manipulating reserves, overstating asset lifespans, or ignoring necessary write-downs. All this helps to create a false picture of the company's financial health. The fraud triangle explains the three aspects that typically exist when fraud occurs. One aspect is that the employee who commits fraud or theft is experiencing some kind of pressure. Often it's some kind of financial pressure, meaning there are huge personal debts, medical bills, addiction problems like gambling or drugs, or lifestyle spending. The pressure can also be related to performance goals, such as unrealistic sales targets or bonuses tied to meeting difficult financial metrics, or life events such as divorce, family issues, or job insecurity, which can create desperate needs. And when pressure becomes overwhelming, individuals seek quick fixes, making them vulnerable to fraud. Opportunity, in my opinion, is the most critical component of the fraud triangle and provides an easy path to commit fraud without getting caught, often due to internal system flaws or poor governance. These include weak controls, such as lack of segregation of duties, like when one person controls the whole process, poor oversight or easily bypassed rules, or management overrides and lack of monitoring, such as inadequate audits, weak risk assessment, and poor monitoring protocols. For instance, when the owner or manager is supposed to review invoices and bank statements, but rarely ever does. The employee might also rationalize the fraud, which leads otherwise honest people to commit fraud by lowering their ethical barriers, making the bad act seem acceptable. Rationalization includes self-deception, where the employee rationalizes it by saying, I'm just borrowing it. They owe me, I'll pay it back later, or I'm underpaid. Rationalization also includes ethical decay, meaning convincing oneself the act isn't truly fraud or that their personal ethics don't apply in the situation. The third factor of rationalization is blame shifting, for instance, blaming the company or circumstances for their actions. As auditors, we're trained to look for these red flags when designing our audit plans. Spot these three factors, and you might just be able to catch fraud before it becomes a big problem. I hope this video was helpful and informative. Most people involved in fraud never thought they would be. Watch out for red flags and remember, see something, say something. Ethics education is about preparing you for those situations so you can spot fraud before it happens. And believe me, this type of situation will happen. Your future decisions will matter most when speaking up is uncomfortable and staying silent is easy.